Well, good morning, everyone. The time has turned 10 o'clock UK time, and welcome to this economics and investment webinar. As always, I am Ben Seager-Scott, Chief Investment Officer, and I'm joined by our Chief Economist, George Lagarias. It has been a very busy summer. If we look at trade tensions, those keep on going. If we think about what's happening in the US, as well as tariffs, as well as some sector challenges, we're also seeing challenges to central bank independence and the White House putting more pressure on the Federal Reserve and some of its independence, something we've been thinking about a lot, and George will talk about today. Closer to home, we're looking at the UK facing down a budget. We're seeing debt costs rise, government borrowing costs are now at the highest level since 1998 at the longer end, and that is true for many other countries around the world. So there is a lot to focus on. Whilst it's been quiet in terms of publications over the summer, the whole team's been here and has been actively monitoring, scenario planning, and wargaming what has been happening. So in today's webinar, if we go to the next slide, please. It will be the usual items, possibly in a slightly different order. We've changed the running order slightly. We will start with George, who will talk about the economics, what's been happening out there, and how we're viewing the world, particularly as we come into the latter half of the year, where we think some of those pressures that we've been talking about that have been building through the year may start to come to pass. And then I will turn over to the markets relatively briefly and portfolios. Of course, we rebalanced the portfolios back in July. We haven't had a webinar since then. Hopefully you received the rebalance note, but I'll talk through some of the changes there before we move to the conclusion and the Q&A. As usual, we've had a couple of questions submitted in advance. So if you submitted a question, thank you very much. If you have any questions you think of through the course of the webinar, there's a little Q&A button. It should be in the menu bar, toolbar at the bottom. So put any questions you may have in there, and then we will pick those up at the end. So with that, if we move to the next slide, which is the first of George's, I will hand over to George to talk relatively briefly, because a huge amount has been going on, though I know it's quite a big section. George, can you talk through some of the highlights about economic developments over the last few months?
Thank you, Ben. Yes. So think about what is happening. Think about the trade war. Think about the nationalization of some key industries in the US, or quasi-nationalization, like the government acquiring a 10% stake in Intel and cutting specific deals with NVIDIA and other tech providers. Think of the say the more centralization of power in the United States, and you can only reach one conclusion, that the country is almost singularly on a path towards containment of China. Okay, this is what historians often call the Thucydides trap. The idea that it is inevitable that two superpowers will eventually clash. Okay, there is not room for two superpowers. So next slide, please. This is the biggest story out there. It's the US versus China. The thick blue line is the US share of global GDP. The green line is the Chinese share of global GDP. Okay, so all that we see happening out of Washington adds up to one thing, essentially preventing the green line from overtaking the blue line, preventing China from becoming more important than the US in the global economy and global affairs. Okay, this means short-term pain for long-term gain. It might mean short-term pain, but they would fail to do so, so longer-term pain would also be involved. At any rate, it means a disruption to global trade and a disruption to the status quo as we knew it. Making things more difficult is the buildup of global debt. Okay, because to grow your economy, essentially you need either more people or more productivity. And since we're not giving births to more babies, And since our productivity has somewhat stalled, then all you can do is just borrow to keep increasing your economy. So next slide, please. As always, and for those who have been watching us for some time, there are the three Ds that we advocate in our basic framework. The first one is debt, which has become the major engine for growth, but now there's a lot of it. It's become a lot more expensive. Second one is deregulation, which can be used to drive growth. And essentially reduction of red tape, and that becomes more growth, but also it becomes more risky, obviously. And at the end of it, the next one is disruption. Okay, because when you have so much debt and so much deregulation, this global competition, well, the one thing that you can be almost certain about is that things will not stay the same and things will not be smooth. And, ordering an iPhone and having it at your doorstep in 3 days might be a luxury that we might not always be able to afford. Okay, because that's what happens when you disrupt global supply chains. Now, next slide, please. What is the economic consequence of that? Part of it is global economic divergence. So in a globalized world, economies sort of moved in lockstep. Okay, but now they seem to be moving in different directions. So the US is rushing through the cycle. It's went from growth and is going to the inflation part of the cycle, whereas the EU and the UK are actually retreating from that. They see less growth. I would argue, although I should put the UK first now that I see it, that the UK will probably eventually even see less inflation than what it fears. Um, and China is even lower in the cycle. It seems to be going backwards because it's fallen into this liquidity trap where it doesn't matter how much it lowers the cost of money, it still cannot get growth going at a pace that would be necessarily satisfactory. So this is a disrupted world and a divergent world. Next slide, please. Does this mean a collapse of global growth? No, by no means. If we look at the IMF's projections from July, they were actually slightly increased versus the ones in April. The US is projected to grow by almost 2% this year, the UK almost by 1%, and the EU also by almost 1%. So we are talking about disruption. We're talking about lower economic growth, even possibly lower trend economic growth, but by no means are we talking about an economic crisis, at least not just yet. Now, having said that, obviously, as we said, our biggest concern is debt. The debt buildup is significant. Next slide. And we're going to use this term a lot, war gaming. So we have war gamed debt scenarios. So if we have a lot of debt, how do we deal with it? The first two scenarios are involve being prudent and responsible. Okay, we can restructure our debt, which would require most creditors agreeing, a very difficult feat. Or we can show fiscal restraint before we are forced to show fiscal restraint. Again, this is an extremely difficult situation and doesn't usually happen that countries voluntarily show fiscal restraint. Now, there is the case that debt becomes so onerous that it depresses growth and interest rates, in essence, Japanification of the economy. And that means the central banks can print a lot of money and nothing happens to inflation, but you just keep buying back your own debt. It's more likely, however, that printing money to buy back your own debt is inflationary. So you can inflate your debt away. If I lend Ben £100 today, and Ben has to pay it back in 10 years, and inflation runs at 10% a year, in 10 years, those £100 will be worth a lot less than it is today. So that's a way for Ben to borrow. But if inflation is too high, in essence, it's not like he's borrowed because the £100 he'll use to repay him in 10 years will be worth a lot less. Now, because of that, obviously, and the way to inflate your debt away is to reduce the value of your currency, which Washington loves, and also the Chinese and the Saudis have followed. The UK has sort of followed, not as much, maybe one third of the way. The Europeans are not following at all, so the euro is strengthening. But one of the possible end games here is that everybody just ends up devaluing the currency to remain competitive. So you see only growth of real assets and precious metals, and this is what you have when you have currency wars. Now, markets are understandably worried about all of this. Next slide, please. Which means that they are pushing yields, especially for longer term debt, like 30-year debt. They're pushing yields up. So this is 30-year debt for the US, the UK, France, and Japan. France in particular has been picking up. There is a no confidence vote on Monday. And it could spell trouble, at least over the short term, for France, although the ECB will likely step in if the trouble becomes too pronounced. The whole point is longer term debt, which governments often use to finance themselves, also where you might find a lot of mortgages, is going up. And it's creating a lot of problems for the economy. Now, the White House is focused almost singularly on having a weaker currency as a growth engine. Okay, because if your currency is weaker, as we said, you can inflate your debt away, and also you can manufacture stuff and sell it more easily. Okay, it's the only way that you can have some sort of manufacturing renaissance. So next slide, please. This is what we call a real effective exchange rate. And as you can see, the US 6 months ago, this is the second bar, the dollar was much more expensive. Now it is a lot less so. The strength can be found in the Swiss franc in terms of currencies. And also a lot more strength in Europe, but the Swiss franc is becoming a problem now to the Swiss. I've been talking to some of them in the summer. Because it's too small an economy to sustain a global reserve currency. So everybody's been buying the Swiss franc like there's no tomorrow, but also Switzerland needs to export some stuff, and it's having a hard time doing that. So this is what we would call sort of a preamble of potential currency wars. Again, to use Ben's words, these are not necessarily base case scenarios. These are war games. As money managers, we are obliged to think of situations that could potentially harm our portfolios and then think of potential responses to those situations. Okay, so that we are ready and recognize a bad instance. That does not mean that this bad scenario is our base case scenario. So I want to be very clear about this. Next slide, please. Now, again, Ben mentioned that. Since everybody the US is looking to inflate its debt away, and a lot of this has been spilled over to the UK. The probabilities for another rate cut in the UK have collapsed, especially after the latest CPI reading. The EU also sees an uptick in inflation, so it probably won't cut rates any longer. Now, the US, which has higher rates, is pressuring the Fed, and it's putting a lot of pressure on the Fed to the point where it might cost the Fed its independence to cut rates. So now markets are pricing in 2 to 3 rate cuts by the end of the year, and more in the next year. This is a larger issue, and we're going to talk a little bit more about it. Next slide, please. Now, sorry. The tariffs. As we said, what are the tariffs used for? They only make sense as part of a broader Chinese containment strategy. Currently, at 17.7%, they create significant pressures on global supply chains. It's a question whether they are sustainable at all. Even at 10%, they were the highest they had been since World War II. So, in essence, a an 80-year-old trend of lower tariffs and increasingly better trade terms between countries has been disrupted. Okay, again, this is not folly. It does make sense if one sees this as Washington's attempt to contain Beijing. Um, Next slide, please. So when all is said and done, we see that tactical risks are somewhat elevated. Again, we're not in crisis mode, very far from it. As you see, the dial is just left to even. Global geopolitics, economic fragmentation, all bad things, trade becoming cumbersome, supply chains becoming more difficult, conflict intensifying, especially in the Middle East and Ukraine, and also policy uncertainty and the deterioration of business sentiment, they're all bad. Okay, inflation pressures we are seeing definitely build up, especially in the US and more sticky inflation in the UK. We're also seeing a cooling US economy, cooling that is not collapsing, that is not a recession, just slower growth rates. Cautious monetary policy, more cautious, especially in the UK. And persistent weakness out of China, which, as we said, has fallen into a liquidity trap. But offsetting these bad things, there are some good things. First of all, the system is still very liquid, and liquidity is very important for markets to run smoothly. And if markets run smoothly, there is a much lower chance of an economic collapse. Most economic collapses, most recessions come when markets blow up, not the other way around. With the exemption of some outside factors like a pandemic, so external factors, you would not see many material economic slowdowns without seeing a financial crash as the leading cause. So increasing liquidity actually mitigates a lot of the economic risks. And adding to that is the so-called central bank put, the idea that central banks are there as the lenders of the last resort. If people need money and the situation is tight, they can lend money to the whole economy. Now, building economic pressures also means building deflationary pressures. So the US might be seeing higher inflation, yes, but offsetting this is, as we said, the cooling US economy, especially the housing market, and also China. China slowing down takes some pressure off the United States. Corporate earnings were very good, and the US especially, they're aided by the lower dollar because 41% of the S&P 500 is in foreign currencies. So if those foreign currencies are appreciated, that improves dollar-denominated reporting. Fiscal policy is broadly loose. I don't think anybody's being fiscally responsible right now. That's why markets are so wired and pushing 30-year yields up. And also, we cannot shy away from the next CapEx cycle, which is here. We're building data centers across the world like there is no tomorrow, and there don't seem to be enough of them. Okay, the AI revolution is here, and with all that computing power, I would argue that our lives will change very soon. Okay, bigger discussion, best not get into it right now. Now, in terms of wargaming, next slide, please. So we discussed a lot what happens if the Fed loses independence. For those who have been watching, Mr. Trump has been trying to oust a Fed member so that he would choose her successor and, in essence, pressure the board to lower interest rates quicker. That would help him finance his debt, especially the short-term debt. And it could help him finance longer-term debt as well, and lower rates there where mortgages are. Now, is there a risk to the Fed losing its independence? Yes, it's huge. The independent central bank is supposed to be the foundation for stability in the modern financial system. Okay, so the dollar would decline. More importantly, countries could lose access, or they could pay very expensive, especially if they want to borrow long term, or they could lose access, smaller countries together altogether in markets. And we would see significant inflationary pressures going forward. So think 1970s, definitely not a great period for the global economy. Okay, now there are things, because as we're thinking about those scenarios, there are things, of course, that mitigate those risks. So if there are a lot of pressures and financial collapse, the government might decide to stop trying to take over, try to stop trying taking over the Fed. The higher courts might also provide some assistance. Generally, a lot of Mr. Trump's legislative initiatives, including the legitimacy of tariffs, have been shot down by the courts. Just yesterday, his 2 billion freeze of Harvard funds was also shot down by a court. There is the possibility that he manages to cause the Fed to lose its independence, and you could see an actual market rally. In fact, this paradox, especially short-term paradox, I think is a likely scenario because markets care about cheap money more than they care about anything else. So lower interest rates, even possibly quantitative easing, you would see a positive reaction. It is feasible that you would see a positive reaction, at least from stocks and possibly shorter term bond holdings. Longer term, there are issues. And of course, there is the central bank put, which is in essence a cop-out. If interesting enough, the Fed loses its independence and this causes markets to collapse, then that would probably prompt the Fed to print a lot more money to the point that we could see the markets turn just because of the flood of cheap money. So keep these eventualities in mind, because even if the Fed loses independence, and we know the risks are huge there are some mitigating circumstances. Next slide, please. Now, the other big debate that we have is the so-called yield curve control. So it is a different thing to lower rates and do quantitative easing, and it's a very different thing to try and control the whole yield curve. Why would Mr. Trump try to control the whole yield curve? If you lower rates and do quantitative easing, you can control the short end, so shorter term borrowing. If you want to control longer term borrowing, which would mean bringing the 10 and the 30-year yields down, which would mean easier loans for people who want to buy a house. And if you really don't care what this does to the dollar, then you would need to ask the Fed to specifically target certain maturities. And we call this and buy those bonds. And we call this yield curve control. Now, a lot in our investment committee would argue that because this is sort of suicidal, the US will not go for it. Why is it problematic at the very least? Because if you target specific yields, then you're telling the market, I'm going to buy every bond that there is out there on the 10-year and on the 30-year. That means the whole market dumping their bonds on you, and then when there are auctions, nobody will show up there. So it could significantly reduce medium and long-term demand for US Treasuries. It would destroy trading desks and would cause massive funding problems going forward for the US. It is sort of a poison pill. So that's why most of our investment committee agrees that while yield curve control is a possibility, it is not necessarily the base case scenario. As Ben said, and I'm not tired of repeating, this is wargaming. So our position currently is that subjugating the Fed means lower rates and possibly some quantitative easing, if needs be. Which again, it's not something the markets, despite the obvious longer term implications, might not enjoy over the shorter term. So next slide, please. What should investors and businesses know? This is a very volatile environment. This is not a one-off thing, so that volatility will likely persist. Currencies will be very important in this environment because you could see governments trying to devalue or even debase them to get better borrowing terms and to inflate away some of their debts. You could see positive earnings trends in the US, again, due to the dollar devaluation. We do not think that the bond market, even at those yields, necessarily reflects inflation risks. So keep an eye on that space because you could see longer term yields going up even more sharply. Having said that, in overall terms of risk, as a few slides ago we demonstrated, we remain broadly neutral. And with this, I would pass the floor back to Ben.
Thank you very much, George. I think that was a really good summary of a lot of the discussions that we've been having over the last few months. And indeed, I think hopefully you've got the sense that that is just a small little snippet of some of our distilled broader thinking. So lots going on, lots to think about, but all of that we use to decide how to adjust portfolios and manage our investments. So for the next few slides, I've got a couple of slides on markets just to frame how markets have been reacting or indeed not reacting throughout this year, and then we'll turn to the portfolios before we go to Q&A. So if we go to the next slide, please. As usual, this is markets. These are major asset classes in sterling terms since the start of the year. You can see that gold, actually, obviously, gold has had a good initial run. Gold is periodically over the last few weeks or so, it has been in the news for hitting fresh all-time highs, sort of $3,500. But I think what is useful to frame, most people, or in fact everyone, when we talk about the gold price, it's in dollar terms. And actually, you can see in sterling terms, which is a good measure of the sort of more broader intrinsic pricing of gold. This is similar in euros, in yen, and so forth. You can see that the value of gold or the buyer's valuation of gold did run up in the first sort of 4 months of the year. As all of the tariff worries started to come through and tariffs put on, that's when a lot of people were buying gold. Actually, for most investors since that point, it has largely moved sideways, and that's where you can see from about April onwards that gold line has moved steadily. What is happening in the US? Because, as George talked about, this move to allow the dollar to weaken, every time the dollar weakens, the value of gold in dollar terms goes up. It stays steady in most other currencies, which indicates the sort of underlying valuation of gold isn't changing. But actually, I think every time we see gold hitting fresh highs in dollar terms, that's actually a story about dollar weakening rather than gold itself. Outside of gold, you can see oil continues to be particularly weak. There have been a couple of spikes as there's been particularly fresh renewed activity in the Middle East, but really oil continuing to drag along the bottom. And then you can see the two green lines, corporate bonds and government bonds on a total return basis have returned you around about 2 to 3%. Bonds are tending to move sideways. George talked about some of the pressure at the long end where governments are struggling to be able to borrow for a long period of time, 20 or 30 years. But actually, that's part of the market that we tend not to invest in. We tend to invest in the area of up to about 10 years, occasionally a few years over. That is the normal part of the market, it's the most liquid part. The longer end gets quite unusual. It's very insightful when we look at government's ability to borrow, but it tends to have less of an effect on the bond pricing for investment purposes. And you can see there, effectively, bonds have moved sideways, but because they've been yielding you 3, 4, 5%, and this is just over halfway, well, slightly over two-thirds way through the year, that's where you can see that return, a lot of it coming from income. And as we've talked about on previous calls, that's what we expect from a government bond and a corporate bond. We're not looking for big price action, though when it's positive, we'll take it when it comes. It tends to be through that income. So bonds very much doing their job there. And you can see equities continue to do well. Emerging market equity up just about double digits for the year so far. And developed market equities, after that recovery from April, and you'll recall back in April was when we increased our US exposure and did that rebalance. Since then, you can see that equities have just been on a steady rally. And really that reflects markets embracing some of the uncertainty, but it's about fundamentals. It is about continued earnings growth and this sense, as George said, when markets are starting to worry about central bank independence and any pressure on that market, what it does is, yes, it causes longer term borrowing costs that we're not really exposed to become more expensive, so asset prices to fall, but it is helping continue to boost this short end and a lot of the assets that we invest in. So actually, markets have been doing pretty well despite, or perhaps even because of the continued uncertainty. So those are asset classes broadly. On the next slide, we drill into the equity, developed market equity regions, just to see what has been working or not working. So if we go on to the next slide, please, this one here, thank you. Here you can see a similar story to what we said before and the complete reverse of what we saw last year. Last year, the US was always at the top, and every other market, even if it was doing okay in its own terms, was a relative laggard. Now the US has been lagging. That's because of all the pain seen up until about the mid to late April. And again, not to labour the point too much, but during that period when the US was the worst performer, we were underweight the US and we topped it up in April. So actually, we've done fairly well out of that recovery in US assets. Japanese equities, that is an area that we like. You can see in the last month or so, that area has really started to improve. And Europe and the UK, 15, 16% return. That is really positive. We have exposure to these areas. As you may recall, we have started to reduce our UK equity. We started that back in April, and that was because the UK was holding on particularly well. What is happening in the UK market is effectively a couple of things. The fundamental underlying UK economy does continue to look challenged. As we look at the business outlooks, what we see is inflation is likely to persist, employment is continuing to weaken, the payroll taxes that took effect earlier in the year are now really starting to bite, and the UK has a big productivity problem. So the outlook is not particularly attractive, but the UK market for the last few years has been very cheap, and it's been that sort of that valuation action. It's lots of global investors buying cheap assets, and indeed some companies buying back a lot of their stock. The buyback story is usually associated with the US, but I think that year to date the UK is actually ahead of the US in terms of companies buying back their own shares. That has done well, particularly earlier this year and the last few months. And that's, I think, another reason to say, whilst that market has done well, the outlook is a little tougher, and those activities, valuations and buybacks aren't necessarily sustainable in that environment. But certainly the UK has done well, and a good opportunity to take potentially some profit within that. So those are markets. If we go to the next slide, please, we'll transition into what's actually happened in portfolios, which I'm sure is something that most people on this call will be interested in. So the next slide, I'll talk just a little bit about the rebalance. Like I said, because we've had the summer break in the webinars, normally we would do this shortly afterwards. The rebalance took place back in July. And again, we circulated a note to investors. If you didn't receive that, please do get in touch with your Forvis Mazars representative, and we'll make sure that you're on the list, that we've got your marketing preferences set appropriately so that you receive that. And we didn't make any huge changes. There were three relatively minor changes, one in the core portfolios and a couple in the sustainable portfolios. But actually, we rebalance portfolios on a quarterly basis. What does rebalance mean? It means all of the market movements, we will reset it back to our sort of default portfolio. That's a really important investment discipline, because it means those areas that have maybe done better than expected, which is great, we take some profit on those to bring them back to our target rate. And when assets have underperformed, we top them up. So it's a really important discipline to maintaining good, effective portfolios. And because we try not to make changes just for change's sake each quarter, when we looked in July, our view was actually the changes that we made in April, that topping up when markets were really looking oversold. We think that, or certainly we thought in April and continue to think, that those portfolios are well aligned for where we are now. And hopefully that's to some extent been borne out. The market slide I showed you in the previous couple of slides that just showed that continued rally in assets from the acute worry earlier in the year has continued. And so we've chosen not to make significant asset allocation changes at this time. The three changes we have made in the core portfolios, balanced and upwards, where we've got a little bit more in equity, This is a very minor change, but our US large cap fund, T Rowe Price, it's a great fund, it's growth orientated, it has done very well for the portfolios and continues to do very well. This is perhaps a little bit more technical or portfolio related. But the group, at the moment, that fund is offshore. It's domiciled in Europe, still all accessible for UK investors because of the way financial markets work. But they're looking to launch a UK domiciled vehicle. Because we have been good supporters of that fund, we've had the opportunity to get access to a cheaper share class. So the underlying fee on that was 0.62. We can get a discounted share class for supporting that launch. And that is effectively us leveraging our scale and our ability to commit to these funds for a reasonable period of time to support a new launch. There's no change to the strategy. It's exactly the same. It's just a new wrapper. The impact for us and for you is we get access to effectively the same strategy, but for a lower price. And that's us really trying to leverage our relationships and our scale to really make sure we're being as cost effective in delivering the investment strategy as we can. In the sustainable portfolios, we've made a couple of changes in terms of global bonds. All we've done is taken our global government bond exposure and we've hedged it to sterling. By default, that fund has a base currency of US dollars. As we've talked about before, we think the dollar is going to remain under pressure. And so by applying that currency hedge, it means we're no longer exposed in that fund to dollar weakness. We've done that in the sustainable portfolios. We actually did it in the core portfolios before for slightly different reasons. There was a fund that the manager left, so we disaggregated that and took up that opportunity to reduce some of the dollar exposure. And in July, we followed suit in the sustainable portfolios more explicitly. And finally, we did make a change in the corporate bond space in the sustainable portfolios, exiting Aberdeen Ethical Corporate Bond, which has been a okay fund, but it hasn't really been adding as much value compared to an index alternative. But rather than going into an index, we've moved into Lion Trust, which is a very high conviction manager. They have an excellent track record, a very strong team. So this is continuing our theme of trying to make sure we're consolidating assets into really high conviction fund managers and not tolerating managers that are effectively just following the herd. So relatively small changes, fund based, but hopefully you'll appreciate all trying to add incremental gains to your investments and your portfolios. So that's it for the changes. If we go to the next slide, this is just going to sort of summarize where our current positioning is. There is no change to the underlying asset allocation, as I said. We took some profit from the UK and we've used that to neutralize the US. I'll just wait for that next slide. There we go. Thank you. You can see there the UK where we were neutral, we've taken that to an underweight position as we talked about some of the challenges to the UK. North America is still neutral. Again, we topped that up in April. We have that overweight to Japan. That's borne out pretty well given that recent uptick in activity in Japan. Within fixed income, not a huge amount to talk about. What I would say, we exited high yield bonds, those most exposed to a potential turn in the economic and investment cycle. What I would say, if you look at the UK government bonds, that's overweight overall, but again, to reiterate, we're in the lower duration part, so lower maturity profile. That's why we looked at those market returns, we saw they were still gaining. Importantly as well, what we have exposure to, you can see in the comments, short duration US tips hedged, which may not mean a lot to you, but what that means is that is looking at US debt with short maturity profiles. So this is debt maturing in the next 3 to 5 years, so not exposed to the sell-off in the long end. And indeed, the part of the market that would benefit if the Federal Reserve is pushed to cut rates more aggressively in the short term. And TIPS means Treasury Inflation Protected Securities, which means these are linked to inflation. So if inflation expectations rise, which would normally be bad for a government bond, these have derivatives that mean they're not exposed to that change in inflation. Indeed, they benefit relative to government bonds if inflation expectations rise. And hedged means that the currency risk is mitigated. So with all of the challenges in the government bond market, short duration US tips actually ticks all of the boxes for our strategic outlook and have continued to do well for us overall. I'll look to wrap up over the next few slides just by talking about performance. So if we go to the next slide, please. Core portfolios first. This shows, as always, our performance year to date of each of the different models. In every case, the blue bar is the core portfolio and the black bar, or dark grey bar, is ARC, which is the peer group that we all submit to. And as you can see, I think particularly at the higher end, the performance there has been very attractive. These data are to the end of July. That's because the August data, we don't get the peer group data until a week or so after the change of the month. So in a few days' time, hopefully we'll have that information. But you can see, particularly in our portfolios that are most equity exposed, our performance has been really strong. And as always, for very boring technical reasons, our cautious portfolio at the moment aligns to the ARC balance. But actually, I tend to think of cautious being aligned with that first black bar, which is the ARC Sterling cautious group, and defensive is really there to be generating positive grinding returns. So actually, I think the portfolio performance versus peers has been pretty good over the year so far. And on the next slide, just taking a slightly longer term view, hopefully you'll see here, yeah, this is the 5-year view, and you can see that significant outperformance, particularly in the more equity dominant portfolios. This is 5 years versus peer group. I think we can be very happy with the performance so far. Doesn't mean that we are complacent, but I think that the performance bears out some of the tactical changes that we made. And again, you can see that cautious, if you compare it to the cautious PCI, is attractive, and even defensive is above the peer group for cautious, which we wouldn't normally expect because our defensive portfolio is at the very, very lower end of the risk scale and at the very bottom end of the sterling cautious bucket. So it aligns there, but it's not really what I would normally consider a cautious portfolio. So a very good story in the core portfolios. On the next slide, we have the same for the sustainable portfolios. We compare them on the same basis, but of course they have a sustainability constraint, whereas the peer group doesn't. But actually, I think you can see year to date, even the sustainable portfolios have fared well. And over the last couple of years, sustainability as a theme has been under pressure. We had a few years sort of in the early days of COVID where sustainability did very, very well. And then the years sort of post that, 23, 24, sustainability as a theme came under pressure. In 2025, they're coming back into play as well. So it is good to see, even with the sustainability constraints, that the sustainable portfolios are just about keeping pace with the peer group. And on the next slide, again, the 5-year view, you can see over that whole period, outperformance, then a drag, but it is good to see that those numbers are starting to be broadly in line with the peer group, which I think is good given the constraints embedded within there. So if we go to the next slide, please, I will just summarize. And again, we'll move to the concluding slide. Should be the next one. There we go. So in conclusion, George has talked excellently about our economic outlook and how that's based around our 3 Ds of debt disruption and deregulation. As George talked about, the US dollar we think is likely to continue weakening. Of course, that could boost US earnings. That's helped propel markets more broadly. But George talked about the inflation risks in there and how they potentially aren't being suitably discounted by the market. Again, in our strategy, that's why we have those US tips, and it's something we're keeping a close eye on. George went into a lot of detail about this scenario analysis. We do a lot of this. This is how, when events happen, we're able to react nimbly. And again, the move we made into the US in April wasn't a knee-jerk reaction. It was a result of lots of scenario planning previously. So hopefully that gives you some insight as to what could happen if the Fed does lose control of its independence and potentially that need to deploy some unconventional monetary policy. So it is not our base case, but if it does come to pass, you can be confident that we're not going to be making it up on the hoof, but rather we'll have a well thought out scenario plan for that. Turning to the portfolios, as we said, we made only minor changes to the portfolios in July and carried out that rebalance. We think the trajectory of where the portfolios are will continue to deliver for us, and that's really been borne out in the markets, which have rebounded, and portfolio performance, as you saw, I think has been pretty positive on most scores. And so with that, we can skip very quickly over the next two slides. It's the topical cheat sheet that you see each time. It means we can't cover everything, but there's a couple of one-liners, geopolitics, tariffs, a bit on AI. If you want just a one-liner, we do think about it, but we're constrained in how much we can talk about on any given podcast. If we look at the next slide as well, the second page, the UK economy and the fiscal situation we've thought a lot about, and that's in focus. Oil price, crypto, gold. We have these views, and here's just a couple of one-liners. But if we go to the final slide, which is the Q&A, I think we can pause there and take questions. There's already a couple of questions in the Q&A box. We have some submitted in advance. So if you do have a question, please do add it in the Q&A now. But I will start going through them, and we'll start with the ones that have been submitted online. And the first one I'll put to you, and then I will take the second one, George. This is: what effects are there likely to be on market as a result of the recent meetings between Donald Trump and Vladimir Putin? I know, George, that you love some geopolitics, so do you want to field that one?
I was muted. Look, okay, that's not an easy one because we have, on the one hand, we have very specific goals from Russia, which is to essentially expand its domain to at least, or at least its sphere of influence to at least its previous Soviet borders. And we have more vague targets from Donald Trump, who really is more focused on containing China than seeing Russia as the enemy. So the key policies are very different. Do I see a resolution for Ukraine out of those meetings? No, not likely. If I'm being entirely honest, I don't think we're closer to resolution now than we were a year ago. But what I do see is the intensifying of global geopolitical competition. Ben, they say that may you live in interesting times in geopolitical terms. Honestly, we probably live in the most interesting time since the 60s. I wasn't there, but obviously.
Okay, thank you very much, George. I will take the next two, one from Andrew and one anonymous, which I think is sometimes the way that Zoom reports it to us. So apologies if you added a name and it hasn't come through. Andrew asks, we often hear about there's a dislocation between equity market prices rising and huge government debts is fiscal and fiscal deficit. Is an equity market correction coming? And the anonymous question is, will there be a stock market crash? The answer to both those is it is always hard to determine whether or not there will be a stock market crash. I think it's a misconception that you see crashes coming. If you did, all active managers would massively outperform. The market itself is the average positioning, the assumed positioning of a huge number of investment professionals. So actually, I think rather than predict stock market crashes, of course, if you give me any one event, could it cause a stock market crash? Yes, it could. The problem we have is not all of them do, and so could current events cause crash? Yes. Will it? Not necessarily. And markets are actually surprisingly resilient. If you look back over the last 10 years, there's probably been 20 different events which could have caused a market crash, and only three or four of them have. And I think actually, if you look at the moment, I'm not sure equity markets are necessarily massively out of kilter. Long-term borrowing tends not to have a huge impact on equity markets. There's a technical reason that equity markets are sensitive to bond prices. It's a discount rate. So effectively, you figure out the cash flows of a company over the next 5 years. You discount it by what you think interest rates will be, because if you don't put it in a company, you could put it in a bank. And so that's why short-term rates do have an impact on the market. Longer term rates don't. You will have seen in the news the the last couple of weeks, we said, 30-year government borrowing is up. Last at these levels since in 1998, I think. That was a long time ago. But the markets haven't really reacted. In the last couple of days, they have a little bit, and that pricing has come in. That is much more likely to be a signal to the government that you cannot turn to the bond market to borrow. This is moving in a slightly different direction, but the government has few options left. It either needs to raise taxes, cut spending, or borrow. It has failed to really meaningfully announce spending cuts. Its attempt to cut welfare spending didn't work out particularly well. This is the bond market saying you cannot turn to us, so you're going to need to raise taxes. And you'll see every time the government comes out and is vague or indicates it might not hike taxes that much, that is when the bond market reacts negatively. And what it's doing, the so-called bond vigilantes are trying to pressure the government. So it is definitely there, and equity valuations are quite expensive. But at the same time, fundamentals are still positive. Consumers are consuming, revenues are high, earnings are good, corporations are continuing to see earnings growth, and fundamentally, that's what equities are based on. At the same time, in the US and elsewhere, there are likely to be tax cuts, either directly to corporation tax or incentives to allow companies to pay a little bit less tax. And if you're paying less tax, that flows through to the bottom line. So, I think it's important to remember that markets are probability machines. And yes, they do look a little expensive, but all of the tailwinds are still there. And indeed, if there is a wobble in markets, as George said, there is a central bank put. And at the moment, the big concern is central banks aren't going to cut interest rates as much as they might previously. And that's a little bit of a fly in the ointment. But if you do see a wobble, central banks will come out and say, we're going to cut rates, and that will be a real spur for the
Can
market.
I add something to what you said, Ben? In
Of course.
2008, in August 2008, credit markets froze. You remember this, right? Sorry, 2007, August 2007, credit markets began to freeze, and we spent a whole year watching credit markets froze and wondering when a market pullback would come. And at that point, the S&P just lost 200 points for a year. That was shortly before Lehman Brothers crashed, which crashed a whole year after credit began to freeze. So the only indicator that we have that there may be impending market crashes or what have you is usually market liquidity. A, as we said, the markets remain very liquid, and B, central banks have learned their lesson, and there is virtually no scenario where the central bank put is not implemented. The crash would come if a central bank said, I'm using the bazooka and shooting money into the markets, and then markets crashed right after. Okay, that would be the really worrisome development. Okay, but we have learned a lot of lessons from 2008, and the most important of which is never let markets linger in a state of uncertainty. Just throw money out there and we'll figure it out later. And that's how we stave off financial crisis.
Exactly. Thank you, George. And that leads very nicely on to the next question that I will throw at you while we're talking about central banks, bazookas, and monetization. There's a question from Mike. Says there's a lot of talk of the US monetizing the balance sheet, and obviously this was one of your earlier scenarios. How's this likely to happen? And do you think that Trump's preference to add Stephen Miram, author of the Mar-a-Lago Accords, to the Fed board is a step in this direction? George, I know you have a vast number of thoughts on this, but let's try and keep it relatively concise so we can answer a couple more before our time is up.
Okay, so Stephen Miran, I think it's Miran, right? Obviously, is a monetarist and obviously is an advocate of the lower dollar as a growth machine for and a way to remanufacture the North. So I think there are no two questions about it. People that are close to Donald Trump do want to monetize the debt. How do you do it? You print money essentially and begin paying off your debt. Okay, and that means, is all of that inflationary? Sure, but as I explained with the example before, The more inflation, the better, the less real, the less debt I owe in real terms. In the example before, you owed me £100. Okay, for 10 years, if there is a lot of inflation, those are going to be virtually worthless. Okay, but it's still £100 that I'm getting at the end of the 10 years. Um, as long as the debt is not inflation adjusted, just a quick parenthesis here. A quarter of the UK debt is inflation adjusted. That's why the government would have a hard time monetizing it if they needed to. Parenthesis closed. So the larger point is they will print money to pay off their debts. And the question is, how much pressure can you put on the dollar before it becomes a problem? The dollar is 10% down versus its previous highs on a trade weighted basis. Historically, it's gone down as far as 40 or 50%. So there may be a lot more where that came from. And Stephen Miran is likely one of the people who would advocate for that.
Thank you very much, George. Excellent answer as always. I'm conscious of time, so I'm going to wrap a few different views, a few different questions into one. Again, market-based. One we had submitted in advance is how to counter the impact of financial and economic uncertainty, and the two in the Q&A is now a good time to buy 10-year government bonds, and touched on US corporate earnings, but what's our view on valuations? I think all these come together. Rather than worrying about economic uncertainty, investing is about embracing that uncertainty to generate a return. And that's why we look a lot at risk premia. We mitigate exposure to any one crisis by being broadly diversified and then applying our tactical tilts. Some of the areas that we are perhaps more worried about, inflation and other aspects, that's why we have tips and we do make changes where we think we're not being rewarded. On government bonds, whilst the 10-year yield, you can, if you can buy that bond directly, you can get a 4.5% return, and that's effectively lock-inable. But I think on a floating basis, 10-year is at the end that is starting to get influenced by some of these debt concerns. So the 30-year is where the real pain is. The 10-year is long enough that it's starting to get influenced. So we're tending to keep our duration a little bit lower in the sweet spot that is more responsive at the near term. And valuations, look, they are expensive. They're not where they were at the start of the year that was very expensive and complacent. So actually what we're looking for is signs of complacency. It's important to remember valuations might look expensive compared to last year's earnings, but in the US, earnings are long-term earnings growth is about 7-ish%. At the moment, this year's expectations are for 8%, and I think it goes up to low teens, maybe 12% next year. So those are very high earnings that can justify those high valuations. So certainly I was more comfortable when valuations were as cheap as they were back in April. They have crept up, but as we said, consumers are still consuming, earnings growth is still coming through. So it's something we're monitoring, and we do have those triggers to move, but that's why I think they continue to be justified. And George, the very last question, and do try and keep it to a minute or two. In fact, I'll answer this last one. What could be the future of labour data with falling participation rates and more volatile revisions? Of course, in the US, the Fed, the statistics chief has been fired, and in the UK, we're having problems with the quality of the data. So can you opine briefly on that, please, George?
Okay, so in the US, they fired the chief of the labor Bureau of Labor Statistics because the president didn't like the data. And a lot more people have been fired, so they're short-staffed, and they're now imputing, which means using past correlations to compute what the current data may look like. So although the non-farm payrolls, we expect the numbers not to show any particular disaster, it's not necessarily that we would put a lot of faith in those numbers. Look, the long and short of it is in the US, even if we could trust the numbers completely, they still have a problem, the same problems of lower labor participation. Why? Because this is the gig economy, and that is that. And also you have a lot of people over 65 who do not count in that data, taking up jobs from younger crowds. And in terms of the quality of the data, I think I would expect a deterioration in the quality both in the US and the UK. So as far as statistics go, I don't think anybody ever anyway trusts those data as, as the holy gospel. We never did.
So a bit more uncertainty, but manageable. That is it. That's our time's up. Thank you all for listening. Any other questions, reach out to your usual representative. Otherwise, we look forward to seeing you on the next one. Thank you all very much.